6:09. I will call the Surgery Waterboard Pension Committee meeting to order. Special counsel, please call the roll.
Director Pacho,
Here.
Director Scholas,
Here.
Director Antrim, Director Kennedy,
Here.
Ms. Shine, Ms. Davis, Mr. Davis,
Here.
Ms. Jonesy,
Here.
Mr. McBull. Chair, we have a quorum.
Thank you. We have a full agenda this morning. So quickly, I'm going to proceed to um, ask you to move into the presentation items. First of which is the executive summary of the January market performance. We also have the asset allocation transition plan. And the third presentation is the RFP comparisons, real estate and infrastructure asset classes. So with that being said, the floor is yours.
All right, great. Well, good morning, everyone. And we'll go through January performance. I believe the packet might also have December performance, so we'll briefly just touch on that as well. But as we look at the performance for the month of January, definitely a more volatile start to the year. So December was a really strong finish. The fourth quarter of last year was a very, very strong finish for the markets. The markets ended up in double-digit territory, as we can see on the right-hand side. Large cap up 26.3%, international equities up 18%. So all in all, the markets were really strong in 2023. What drove the market bounce in 2023, particularly at the end, was the belief and the signaling from the Fed that interest rates were likely to not go up between November and the remainder of the year. And then ultimately, we also saw the Fed and the market signal potential interest rate cuts in 2024. Interest rate cuts are typically what they call a tailwind for the markets. If you think about the dividend discount model, you think about how you value a security, interest rates coming down will essentially lead to an increase in valuation. So that really drove the strong returns in 2023. Now, the beginning of 2024, what happened? Why did we see losses in some asset classes and then modest returns in other asset classes? And what happened was strong economic news. Strong economic news is typically a really good thing. The market should react favorably to that. But strong economic news in this environment also just puts some uncertainty and question marks around interest rate policy. So if the economy is really, really strong, it does mean that the Fed is less likely to lower interest rates. But as we've seen as the year has unfolded, the Fed has been a little clearer with respect to its interest rate policy. There was a pretty good piece on 60 Minutes where, without giving too much to the public, the Fed did show that it was still looking at interest rates and it was still contemplating rate cuts as part of its overall strategy. So the good news here is, while we've seen more volatility in the market in 2024, statistically speaking, the market is positioned for another positive year. Why do we say that? It's an election year. Typically, election years are years where the market does really, really well. 2008 was, the one exception we can think of in recent memory. So this page here, again, just underscores the more volatile start we've had to 2024. Some areas in the market doing really well, particularly the large cap. Other areas of the market pulling back a little bit. But as we think about the year and as the year continues to unfold, still pretty positive outlooks when we think about the market. So U.S. economy, we touched on the Fed interest rate policy. Policy has been tied to inflation. So 2% is the long-term target. But as we can see here, inflation has come down pretty meaningfully. So following the immediate COVID period where things were essentially returning a little bit back to normal, we saw inflation in the high single digits, around 9%. So to be down below 3%, and again heading towards that 2% mark, gives us a sense of some of the news that the market has looked at favorably. And with respect to the market favorably, we're looking at potential cuts, or the market's pricing in potential interest rate cuts as soon as May. Originally, going into 2024, the belief was the first cut could have occurred as soon as March. But given the strong economic data that came out at the beginning of the year, that's now been pushed back to May. So again, explaining some of the volatility we saw at the beginning of the year. Now, as we've discussed in previous meetings, there is an inverse relationship between interest rates and the value of your fixed income investment. So with the fact that interest rates are still kind of sticky at this point and they haven't come down, you're seeing a little bit of volatility on the curve, particularly with the AG index. So the AG index was down 30 basis points. Intermediate, so just going to shorter duration fixed income, you see a lot more stability in the intermediate side of things, where that was up 20 basis points for the month. And then as we go further down, we can see that there's definitely a stronger inverse relationship the longer the duration of the fixed income instrument. So long government down 2.2% over that same period. And the real difference is the maturity of the fixed income instrument. The yield curve we've discussed before, still inverted at the short end, meaning that shorter term rates are higher than longer term rates, but that has continued to normalize to some degree. If we do see interest rates come down at the short end, that's where you expect a normal shaping of the yield curve. So shorter term rates would be lower than longer term rates, which is a normal behavior of the yield curve. But what we're seeing now is some of the shorter term rates actually higher than the longer term rates. So if we go out to, let's say, 10 years, you can see that the curve still is higher at the shorter end versus, let's say, the 10-year maturity. So as rates do come down, we expect a normalization in the yield curve. U.S. equities have continued to have a really stellar period of performance. But during that stellar period, you are going to see some cooling off in certain segments. So mid cap and small cap, these are areas of the equity market that we continue to be bullish on. We think it makes a lot of sense for a long-term asset allocation. But over the short term, we've definitely seen some volatility come in at the mid and shorter end of the cap spectrum. What's really rallied well has been large cap, and again, the Magnificent Seven is probably the magic word of 2023, potentially 2024. But the Magnificent Seven, these are your AI themed, dominated, correlated stocks that have done really, really well. These are large cap in names, so you can think about your mega cap, multi-billion-dollar, market cap type entities out there. That would be your Metas, your Alphabets, your Nvidias, Teslas, Microsofts, and so on. Information technology, just to my point earlier, information technology, again, the AI trade has definitely carried the U.S. equity market pretty significantly, and that wasn't changed in the month of January. Non-U.S. equities also going through a pretty good period of performance. The big difference between non-U.S. stocks and U.S. stocks is the growth element, the Magnificent Seven. When we think about the U.S. stock market and the S&P 500 versus the international markets, technology represents around 30% of the index in the U.S. Technology represented about 12 to 15% in the non-U.S. space. So a lot of the differential we're seeing in performance is relative to technology driving the U.S. stock market and less of a growth surgence in the non-U.S. markets. We mentioned IT doing exceptionally well in the U.S. You can see outside the U.S., healthcare was the top performing sector in the non-U.S. market. Real estate, we'll talk about this momentarily, but this is definitely an area that over the long term is a very thoughtful place to diversify. Over the short term, we are definitely seeing a lot of pressures, particularly in the office sector. We'll talk about that momentarily as we're going through the candidates to take a look at. So more to come on that. But the key thing here is long-term, we continue to think this is a great diversifier for portfolios. But again, over the short term, definitely going through some rotation or some pain, particularly in the office sector, which has not really recovered from, the back to work post-COVID environment. As we look at the allocations to the various segments of the real estate market, we do continue to see office playing a significantly less dominant role, and we see other areas like industrial continuing to gain prominence in terms of portfolio exposures.
Kwaku, that industrial, is that like a plant or like a bottling plant or the refineries? What is that industrial?
Yeah, so industrial, you can typically think of, if it's part of, let's say, the Amazon or like distribution network of, online retailers, I think that's the most common example that we can come into. So that's an area of continued growth, steady growth. And as we saw during COVID, it's been pretty robust in both, booming and contracting economic environments.
In the retail office, that decline likely to continue is why?
Yeah, so office space, I would say starting with office first, back to work has been very different. The work environment, I think everyone looks to be Gen X here, so we can talk, well, Gen X or generation before, so we can talk a little bit more candidly. The younger generation back to work and being in the office 9 to 5ing is just, it's a different climate, different environment. So we're definitely seeing more organizations embrace the hybrid working schedule, and that flexibility around work has led to less demand for office space. Less demand for office space has led to a lot of surplus inventory. And then with interest rates up pretty meaningfully, transactions are down pretty significantly in the real estate channel. So combining those two things, the areas of most interest continue to be industrial, because irrespective of how COVID impacted the economy, industrial has just been a dominant feature in the real estate market. Whereas again, back to work is very different. It's more virtual, it's more flexible. So office space right now is being looked at. How can you reappropriate it? Can it be defined into something else? On the retail side of things, retail has recovered, I'd say, pretty meaningfully from the COVID era. So during COVID, hotels, obviously, retails, and office space, they were under a lot of pressure. But with retail, we've definitely seen, particularly with the grocery anchor chain, strip malls and so on, the Amazon effect, the Whole Foods, the buyer experience, that has resurged to some degree, just not to the same magnitude as let's say, industrial.
And it's not going to come back at all. On the forecast, office space, they actually transforming most of the office space to the condos and stuff.
Yes, yeah. So in the big cities, that's the thing. These are prime properties. So it's a weird thing when you see some of these properties marked down to zero, because if you're in a certain part of the country in a certain location, it's not zero. But right now, it's just not useful for office space. But to the point just made, we're definitely seeing a reappropriation. So at some point, that will level out with all markets. I think the best way to look at it is, everything mean reverts, right? So mean reversion means if something's doing too well, at some point it will have to lose some value to come down. If something's doing too poorly, at some point it will have to bounce back to go back to its historical norms. And as we think about real estate right now, as uses for real estate are evolving presently, that's why we're seeing a little bit more of a lag. But going forward, and I think this exhibit is a really good example of that, going forward, real estate, there's always a need for real estate, whether it's where you live, whether it's industrial uses, other uses. Real estate continues to be one of the most robust asset classes out there. So when we think about real estate over the last 24 years, there have been 3 years where it was pretty meaningfully negative. We can all remember 2008, 2009. Real estate was the cause of the global financial crisis. 2023, that's more the COVID effect that we just discussed. But all other years, when we move out to the right-hand side, a really, really good performing asset class, and it has been a good diversifier. So, more to come on the real estate discussion, but the key takeaway here is long-term, we continue to favor it within asset allocations, continues to be a really good diversifier in our opinion. Infrastructure, and this is the subset of the real asset space. So infrastructure, like real estate, is an area of the market that focuses on physical assets that have a purpose and a use. Those physical assets will also generate some cash flow in the form of rents or in the form of usage fees. So infrastructure, these are really the backbone assets of any economy. And when we compare infrastructure to the other indices, we do get a pretty good sense here that infrastructure also has been a good investment over the long term. So over the long term, looking forward, we think that infrastructure is a really good diversifier to any type of real estate exposure. Infrastructure, one of the best components of infrastructure investing, particularly for investors, is the yield component. You're looking at yields that can hold up very well relative to the broader market, and the yields have also seen a lot of stability as well. So another attractive feature of the asset class.
As far as the infrastructure, so you're talking about the public bonds?
No, so this is a little different. So within the U.S., you've got the municipal market. So that in the U.S. has really captured.
Because that's where most of the infrastructure comes from.
Correct. So the funds that we will discuss momentarily, these are global in nature. So the global component will also take into account, the developed markets, the countries that don't have a municipal bond market, but use an infrastructure market to essentially finance the essential goods and services they've got. But that is correct. So, municipals in the U.S. have typically been the source of financing for infrastructure outside the U.S. Other mechanisms, particularly these funds.
But when you talk about infrastructure, it's mostly state-owned.
Yes. So and the good thing here is we'll look at, the goal today is to have, your guys' blessings on not moving forward with a recommendation, but moving forward with candidates to interview. And during the interviews, we will find that, public-private partnerships, examples of how infrastructure has evolved, particularly in the U.S.
Thank
you. Private equity, we had a really good discussion before the end of last year, and this is just, a reminder here that private equity continues to be, a good diversifier that clients like. Is a good diversifier to the equity markets, your traditional equity markets, and the goal of your private equity is really for strong returns over the long term. Year performance, the takeaway here is some years are really good, some years are perhaps not so good, but being with managers that can consistently invest across a different cycle, that's advantageous. So this takes us to the portfolio review for the month of January. We can see here pretty good returns, all the way to the right-hand side. We do see for the 1 month period, we did underperform the index a little bit by 80 basis points. But again, a lot of the noise that we just mentioned in the market does make a lot of sense. We have, large cap, small cap, mid cap exposure. Large caps did really well. Mid cap and small caps underperformed relative to large caps. So that really does explain some of the performance detraction we see. So nothing surprising with respect to the 1 month performance. And then looking further out, longer term performance has been pretty good for us. As we look at the composite performance, we see that the fixed income composite held up pretty nicely. As I noted earlier, with the equity composite, we'll see that small and mid underperform large cap. So a little bit more of a tilt towards small and mid relative to the index would have led to that relative underperformance. And then as we look at the real estate composite REITs, those have continued to perform more or less in line with the REIT index, and then the infrastructure composite also performing more or less in line with the index as well. Top performers as well as bottom performers, we see good performance coming in from Fidelity on the fixed income side. And then Earnest Partners, we're looking at relative detraction from Earnest Partners on the non-US side. But again, nothing that warrants any action. This is just more of an FYI. As we look at the targets versus the approved allocation, we do see that the biggest underweight is to private equity. Not a surprise here, just given the nature of the asset class. Will take a number of quarters to get to target with this specific asset class. Here's an example of, here's a list, I should say, of actions taken over the last couple of years in the portfolio. So just going through till this time last year. And then quick recap on the approved asset allocation. So we do have the private equity, that part of the checklist can be checked off for now, I should say. But then infrastructure and real estate, these are areas of the portfolio where we currently do not have private management in place. So real estate, that would be a 3% allocation or 3% target. So we'll see momentarily for that 3%. In our opinion, it would make sense to look at one manager. And infrastructure, definitely one, potentially two managers to take a look at as we think about filling in those allocations. And then on the US side of things, as well as non-US side of things, we'd also be looking today, I believe, to get approval to have RFPs issued for mid-cap and small-cap domestic, as well as non-US small-cap and emerging markets on the international side. So still a few more moving pieces to consider.
Kwaku, could you go back to the slide with the pie chart?
Yes.
Okay, the real estate allocation. I just couldn't differentiate the colors. Which one is the current allocation for real estate? What's
So
the-
it's the 20 basis points or 0.2%.
Okay,
That's the real estate composite right now. And that's in REITs, real estate investment trusts. Those are daily traded stocks of real estate companies.
Yeah.
Good to move on?
And
Okay.
Yeah.
on that, the final slide you showed, you talked about transitioning to a core open-ended private real estate strategy.
Yes.
What does that look like?
Perfect. So
Is that, am I queuing you up?
you are queuing
Okay,
up.
then,
So
then we can just go ahead. You don't have to.
perfect.
Yeah.
Perfect. So these are just, for everyone's notes, these are just snapshots of the money, where the money has flowed as we've rebalanced the portfolio. So we put the months and then the amounts and where the money flowed to. So what's in red is an outflow, what's in green is an inflow. And then the date is on the right-hand side. So this particular page takes us to current and future searches. So we did, on the private equity side, select Mesirow and Sango. So that was at the end of last year. Today, we'll do a quick recap of the candidates we looked at for infrastructure. When I say we looked at, these are my colleagues on our research team that have put together the analysis and the candidates to take a look at. So infrastructure and private real estate, we're looking at approximately 15 million in infrastructure, 7 million in private real estate. And then as we think about the RFIs, these are the approximate dollar amounts when we think about the RFIs to be issued and the asset classes. So non-US small cap, emerging markets, US mid cap, US small cap, core fixed income, and then the corresponding dollar amounts are, in the middle column.
Quickly, this may be a question you're going to answer. when we talk about global infrastructure and private real estate, are you looking at same possibility of having a couple of managers in those areas as we did with private equity?
So yes, the quick answer is for infrastructure. I think for infrastructure, and we'll go through the manager options in a moment. So that's why it won't be a clear yes or no. For infrastructure, we can definitely look at one manager, but we can also look to split the mandate if there's a little appetite to add a little bit more illiquidity to the infrastructure allocation. So the managers will have core open-end managers. So two managers, these are core managers. There's what they call a soft lockup, where you can get your cash and you can redeem back after a set window of time, typically 3 years for that allocation. For the closed end, that's where it's locked up a little bit longer. You can think about 5 years plus. And in discussing the pros and cons of both different styles, we could either have just one core open end to be revisited later as our initial allocation, or we can have a blend of the core open end and the closed end for the infrastructure. For the real estate, because it's a relatively smaller allocation of 7 million, we don't think it would make sense to split that mandate. And there's one manager in particular that we think would be a really good manager to go into at this point in the cycle. You'll see that the manager that we're recommending for real estate has a significant underweight to office relative to their peers. So from an investment thesis standpoint, you're not going into a heavy allocation in the asset class that's being discounted the most and being pressured the most. So hopefully that answers the question there.
Okay, yeah.
Yep.
Thanks.
Okay, perfect. So this is the memo. You have all seen this before. So really just sticking with the same document, so that way for historical purpose, references and so on, you all get a sense of who the respondents are to the real estate search. The research team took the RFP responses that were received last year and then really highlighted 5 candidates they considered to be tier 1 candidates. So a lot of managers respond, and then of all the responses, we end up having 5 firms that we, based off the views of research, think are the best choices to go with. So we have Clarion, DWS Reef, Principal, TA Realty, and Stockbridge. What all of these managers have in common is that they're core open-end real estate funds, meaning that they invest in a very specific way, and they're measured to a benchmark known as the Odyssey benchmark. If you look at an open-end real estate fund versus a closed-end real estate fund, what's the big difference? The big difference is the leverage. So with an open-end real estate fund, you can think about the real estate fund owning about 90% of the properties, and then let's say 85% of the properties, and then 15% of the portfolio is levered up. With a closed-end fund, you can think about 100% or a little bit less than that of the fund being levered. So core open-end, it's really the physical property that's being invested in, and it's the cash flow that's the biggest component of the expected return over the long term, where you can expect some appreciation and depreciation over the short term. But these are the firms, and you'll see that these are all, pretty large entities by name. So DWS Reef, Deutsche Bank, humongous entity. Principal, again, another household name. So these are, multi-billion, pretty significantly stacked companies when we think about.
Yeah, but isn't it Deutsche Bank just reorganized?
Yes. Yes, Deutsche Bank is reorganized, and Deutsche Bank, because they're German, they're based in Europe. Culturally, they're just very different from how your typical U.S. Investment bank would work. So what we've seen with Reef in the U.S. has been more of a separation between the asset management group and the investment banking group for the reasons you just mentioned. I think for the asset management group, it's been a little bit of a headache to always be answering for what the folks are doing in Stuttgart or wherever. So ultimately, the asset management group is pretty isolated from what
What
Deutsche
you're
Bank is
saying
doing.
is that European operations is different from the US operations.
Yes, absolutely.
Okay.
And that's been a deliberate effort. So in fact, DWS, they don't put Deutsche Bank there anymore. So they're slowly moving away from that name association and just focusing on the asset management business when DWS's name is mentioned. But we get a sense here of just how big these organizations are. The portfolios, the smallest one is 4.7 billion in terms of its size. So we just get a sense of how big these organizations are. Clarion, 21 billion, DWS, 18 billion, Principal, 13 billion, and then TA Realty is 8.1 billion. As we think about the characteristics of these firms, there's a lot in common once again, where you're looking at the leverage number being relatively low, meaning that the bulk of the portfolio is owned by the fund. When we think about what else, the fixed versus floating debt, you're going to see that a lot of the debt is going to be fixed, meaning that you don't have to worry so much about refinancing risk and so on. In terms of the investments, these are very diversified portfolios. The Stockbridge portfolio is very diversified, even though it has the smallest number, 66 holdings. Occupancy is huge. So these are typically over 90% occupied. And then as we think about a good source of returns again, it's from the strong contracts, tenants with exceptional credit ratings that lead to the biggest source of returns. As we think about the ownership, definitely the ownership of these entities, it's very different from what we looked at on the private equity front. You're looking at mega corporations. You're looking at entities that are in a position to buy, huge chunks of real estate. So while we do see diverse representation on teams, there's no diverse ownership when we think about the core open-end space.
You said there's no diverse ownership?
No, in terms of the firm. So, private equity, we were able to look at firms that had different ownership structures, majority owned, diverse owned, and so on. In the core open-end real estate space. So again, this is the large real estate managers. You're looking at, again, in the tens of billions. It's typically insurance companies or spin-outs of insurance companies that started the core open-end real estate space. So for that reason, you've not seen ownership that's significantly diversified for this particular asset class. The same can also be said for infrastructure as well, where you think about physical infrastructure assets, these are entities that are, again, majority owned, but still from a representation standpoint, within their teams or within the organization, may have healthy amounts of representation.
If I could ask on that point, I'm just curious, maybe this is totally unprecedented, but is there any room where we could, rather than invest with a large organization like this, take what we'd like to put into real estate and invest it on a more individualized basis, perhaps in individual projects, or create a fund of our own of some kind where we can invest locally in real estate projects? Because I know locally the problem with a lot of development projects, in particular with minority ownership, is like small short-term gap financing that potentially with this amount of money we could maybe help to fill that gap and like play a role in the local marketplace rather than taking your money elsewhere.
Yeah, so I would say that aspirationally, what you mentioned makes a lot of sense. From an execution standpoint, we've typically seen, particularly public entities, stray away from that, whether it's moral hazard, whether it's running into issues with tenants. Let's say, for example, you're a public entity, you own a property, and then people are behind on rent. What do you do there? So while again, it would be the right thing to do, we've seen funds steer away from that. Now, I would say that community trusts, the foundations, endowments, and so on that have different missions, we've seen some of them take up some of the ETI or the local investing, but on pension side of things and looking at peer groups and kind of looking at peer groups as a barometer of what we can and cannot do. The moral hazard has been, I think, a pretty big hurdle when we think about local investing and procurement and so on.
So quickly, could I offer, there are locally owned investment firms that specialize in real estate. The capitalization is really small, cap size is really small, that do exactly what you're asking. They're private entities, so there would be no conflict. You wouldn't fund to this scale because it's beyond what they do. But, theoretically, I'd like to hear if we couldn't slice off a small piece to that effect, because you're talking about, low seven figures to that effort, right?
Yeah.
Not something that's gonna, be a whirlwind, but for those entities, this body could participate, right? In theory, quick, right? Or is it, if it's a really small cap, does that just, because I know we have our tier 1 criteria.
Right.
That's what keeps these funds from being mentioned and even from them responding because
Right.
they don't meet the, the requirements, right?
Right.
So in theory, would we be able to carve out, a second tier allocation to that effect for these smaller local Louisiana firms that invest in local real estate projects?
I'd say the quick answer is perhaps not for this search, only because this was an open search.
Sure.
We had the RFP come out, we had responses. We didn't receive responses from any of those firms, so we can always take a look. It's something that we can always revisit.
Yeah.
But for the purposes of keeping the asset allocation discussion going, our thought here would be to at least just move forward with these candidates. They responded, they were analyzed, they were reviewed, and then we're happy to take meetings with anyone local with the understanding that, look, it could be years between the first conversation and anything happening. Something may never happen, just given the size and the scale and some of the complexities that come with some of the smaller firms. It's not being biased against smaller firms, it's just more core open-end real estate has a very specific role, and the cash flow component is that specific component of return for us. It's a nice diversifier for the equity market as well as the fixed income market. And then the other thing which we haven't discussed is whether you guys, not this portfolio, but this entity, whether it does own real estate, across the city, because that would also, lead to a double counting, right? So if we own infrastructure, we own plants, or we own operations here, we are already investing in real estate. So we just want to make sure we're mindfully diversifying the portfolio exposure. So it's a long way of saying we can definitely continue that discussion, but I think for this real estate conversation, just keeping it to those that responded, the RFP, what's been vetted by research, that keeps us going according to the asset classes we'd like to at least move into at this stage in the portfolio.
Having said that, would you suggest, or do you have a suggestion for a timeline when we could revisit that?
Yeah, I mean, I would say, in all honesty, once we've gone through the real estate search, we've reviewed the candidates, we've gone through paperwork, we're probably like well into 2Q, going into 3Q. And then depending on the queue coming in to the manager, it might be towards the end of the year. So we could definitely look at this as a discussion or something to review once we've got the whole asset allocation behind us. We've still got the equity RFPs to go out and those managers to vet. So how about this whole phase of asset allocation is behind us, and we can kind of pick up a timetable and think about ways in which we can look at and discuss and research other managers.
So I guess we've had this discussion. We actually were interviewing you as our asset manager.
Right.
How we support our community and our neighborhoods.
Sure.
How we support our population and our people. And I want to sort of put a marker down, so supporting my colleagues here to say that in whatever process we're looking forward, there should never be barriers to local people applying for and being supported by the workers of the Sewage and Water Board. And I want that to be a very clear directive. So I don't want to create situations where we have to revisit because they were directly or indirectly, intentionally or unintentionally excluded from the beginning.
Yeah, I would say in this particular instance, it's no one has been excluded because this is a core open-end real estate. So if there were core open-end managers that were local, absolutely, we could look at the criteria. But these are national firms, and this is to a size and scale that institutional quality pension plans take a look at. When we think about the local managers, and again, no issue with anyone locally, like I always get in trouble whenever I talk about local managers, but there's nothing, there's no issue with anyone local, but sometimes what's available local may not be, what could be the right fit for the portfolio at any point in time. I would say that as we think about real estate and the role of real estate in the portfolio, we're more than happy to see who's local, who's available, take meetings with them, and then ultimately get a sense of how they invest, the types of clients they have, what their investment thesis is, and if it makes sense, we'd be more than happy to continue discussions or see if there's an RFP process. But again, for the purposes of this asset allocation, it's core open-end real estate. Core open-end real estate, unfortunately, is very specific, and being very specific, there are only certain types of managers available in this space. So we'll continue to, look for the best managers, period. But in this particular instance, it's really tough to say there's a Louisiana-focused core open-end manager, just given the structure of the asset class.
Not only that, according to if they didn't respond to the RFP, you cannot suck them in. You cannot bring them in because according to the public bid laws, they have to be a respondent to the RFI.
Yes.
RFPs.
Correct. So this would be.
It's not somebody can be injected in if they didn't respond on the public.
Correct. So yeah, we wouldn't be looking to do that. I think what we would be looking to do would be once all the RFPs are concluded, if there are firms that believe that, look, they're a good fit, they're a good complement to the portfolio, we'll happily take a meeting. Oftentimes the belief of being a good fit or being a good part of the portfolio has to get reconciled with the reality of whether they would be or not. So we're happy to have that discussion, and hopefully just being upfront about the universe of managers out there also just helps to point to why we're looking at these funds and no one local, because it's the core open-end space at the end of the day we're taking a look at. But really quickly, summaries of the managers, you get a sense of what they will do. They are focused in office, retail, industrial, hotel, and multifamily. Those are the core areas of focus. I think one of the things we want to point to here are the various allocations across the various strategies. We see that, again, multifamily, industrial, office, retail, other that can be developmental or self-storage. We see that TA Realty, which is TA Core, It's the dark color that has the biggest underweight, or the lowest allocation, I should say, to the office segment. And as we think about how they're invested, you'll also see that they have the healthiest allocation to the southeast part of the country. So as core open-end real estate managers go, we feel that this would be a good manager to bring in for discussion. We feel that, because again, it's a 3% allocation, this isn't a mandate that we would want to split. So, for that reason, we would recommend bringing in TA Realty for additional discussion for potential inclusion in the portfolio.
But they had the 50-50 allocation, 50-50 free. If you go back 2 slides, they were out of the norm. The fixed versus floating.
Yes.
Can you explain that a little more and why that's different than everyone else on the list?
Yeah, so TA Realty, if you compare them to, the other firms, they are a newer manager in the core open-end space. So being a newer manager, the terms that they're able to secure are going to be a little different from, let's say, your Clarion or, your DWS. But the 50-50 split, if you look at the average loan maturity, I think that's the important thing to point to. The average loan maturity is 4.8 years. Interest rates are projected to go down. So the 50-50 split, if we were in a rising rate environment, that would be something of huge concern for us. But the fact that rates are poised to go down, 50% of the debt is floating, but the average maturity is 4.8 years. It's something we can definitely ask them if you'd like to bring them in, but it's not of material concern to us. I think what is of material concern is the sector exposure that these funds have versus the financing, particularly where interest rates are positioned to be on a go-forward basis. But they are a newer manager in the Odyssey Index, so that's one of the reasons behind the split that we see. Not sure if it answered the question or not, so let me pause for a second.
I don't know, just picks up as an outlier to me when we're looking comparatively.
No, absolutely. I mean, one thing we can do as well, rather than just look at the one manager, is I was trying to be mindful and think about where we could go straight, but if you wanted to have another manager for comparison purposes, we could definitely look at that. So that way, in their responses where they're talking out the debt exposure, fixed versus floating, we do have a benchmark to compare them against. So that's also an option I wanted to put out there, if that makes a lot of sense. I mean, the fixed versus floating, again, that does stick out as an outlier, but the biggest outlier would be how the portfolio is constructed. So a Odyssey fund isn't limited in terms of how much fixed versus floating debt it can go into, I believe. But at the same time, an Odyssey fund is going to be constrained in terms of how much leverage it can take. It's going to be constrained in terms of the sector exposures it can have. And I would say on those questions, you're looking at someone or a firm that's in line with the benchmark. And again, it's a relatively smaller fund, so it's 8.1 billion versus a 21 billion versus an 18 billion fund. How they're going to secure their financing is going to be very different because again, 18 billion versus an 8 billion, you're just looking at different lending terms at the end of the day. So that does explain it. It's like if you had 8 billion, I had 21 billion, or we flip it, we're going out to expand and finance, the 21 billion is going to have different terms available for it from a financing standpoint versus the smaller fund. So
But
That-
Stockbridge Smart is not in line with what you just said, and it's also a smaller fund.
It's an older fund, though. So Stockbridge it's an older fund, so it's been around longer.
Okay.
So all of that does kind of add up. But again, we can bring in more than one manager. I really wanted to make sure that when we talk out real estate in this environment, we've gone through office and just the write-downs office is taking. Office is really going through a lot of pressure. Talking about the relative ages of the fund. Of the funds, you can see here, for example, Stockbridge and TA Realty, they're going to be more skewed towards the south than the more established funds. So these do lead to differences in their overall exposure, including the financing and so on. But we can definitely, if you guys think it would make sense, I think a firm like Principal, which is another large firm, just shy of 13 billion. If we take a look at their overall debt, fixed versus floating, and so on, they are very different to what we're seeing from TA Realty. So they could be a good comparison there. Bless you. But you will see with Principal, I think they have the highest allocation to office. So at the end of the day, I think they would be a really good comparison. And when we think about core open-end real estate, the other thing that we look for in terms of whether it's a green flag or a red flag is the consistency of income performance. So is the yield consistent? Are they getting good cash flows? And ultimately, in our opinion, TA Realty, with the underweight to office space, does fit that criteria. But hearing that, look, comparing them versus someone else may make more sense, I think having another manager in the Odyssey Index to compare them against is definitely fine. No issue on this end.
A quick, do you mind if you remind the committee on the private equity search for any of the top tier? We invited all the top tier to make a presentation to the committee to help with the decision-making process, or like a subset of these 5?
Yeah, I mean, that's true. So yeah, for private equity, because we'd never invested in private equity before, we ended up bringing in, was it 4 candidates? The 4 candidates, just to show the different flavors that they do provide. Now, on the Odyssey side of things, it could be overkill to bring every single manager in. But yeah, absolutely. If
2 or 3.
If schedules permit, and that would make the most sense. I would say let's pick some managers to bring in. Again, from an investment thesis standpoint, TA Realty, in our opinion, makes the most sense because you're not going into a fund that has a bigger allocation to the most distressed segment of the real estate market. So with that, disclaimer, Principal, Stockbridge, Clarion, all firms, DWS, all firms that we know, exceptionally well, have good amounts of client exposure in. I'm happy to give you my thoughts and recommendations. We can jump into.
Can you explain, though, what weight you put to geographic weighting? Because that has a significant economic impact as well.
Yeah. So I think geographic weighting is important, but I think it's really from a manager standpoint, you're going to see with the newer managers more in the South and the Southeast, just because the property boom, the East Coast and West Coast became a lot more expensive. And for a newer fund, it just made a lot more sense to not overlook the parts of the country that are developing tremendously. Your Atlantas, your Houstons, and so on have, represented, Austins have represented a bigger portion of the index. So I would say with newer managers, I do like to see more in the way of Southern exposure with newer managers because Again, COVID has kind of reset how individuals work. Migration, people are moving from the east and the west more to the southeast, for example. So I do like to see that with newer managers, because they're not, with a newer manager, if they are loaded up on the east and the west and so on, it means that their price point was not as advantageous as someone that had been there decades before. So someone that's been around for decades, let's say a DWS or a principal, the geographic exposure it's important, but is less of a concern, because the cost basis that they had was a really good cost basis, right? They were able to average in over a number of decades into these very expensive markets. And for new firms coming in, I think it's a very smart strategy to still have exposure across all segments of the country, but really focus on, again, the boom that's happening, particularly in this part of the country.
What is the average portfolio size of these companies? Because if they are $1 billion, they put the same kind of attention to our smaller portfolio.
Yeah, so we would be going in. It would be a commingled fund. So the good news is that these strategies are all managed, top down from a team, right? So whether you are $1 million investor, $100 million investor, $1 billion investor, it's the same strategy you're benefiting
No,
from.
but my question is, what is the average portfolio size these company manages?
Oh, I mean, off the top of my head, I'm not sure.
Because I
would
mean, when
say-
you're screening and putting down this short list,
Right.
this is one of the criteria which you should be looking at, because we want a company which can put as much effort into our portfolio than 10 times bigger.
Yeah, so yeah, back to that. Because we're going in the commingled fund, our size is not, it's not an issue, if that makes sense, because the same strategy is going to be deployed for us versus someone that's significantly larger or significantly smaller. So we're buying a unit of the fund and a unit of the investment strategy, as opposed to the team.
The size of the portfolio.
Yeah, exactly. So, yeah. So if you guys like, we can go ahead and think about a short list of core open-end firms to bring in. And with the core open-end firms, again, I would say Principal, TA, and Stockbridge, if you're looking at, two newer funds, just to get a sense of how the two new funds are similar but different. And then Principal, again, a very established, older strategy that's out there. So those would be the three names. I know when push has come to shove and in discussing with research, okay, which names can we pull? Those have typically been the three that have come in.
We met with the other companies within a month after you made the recommendations. Are we looking at the same timeline?
Yeah, I would say the same timeline. So and we still have the infrastructure search after this, so I'll be a little quicker for that. But yeah, we would look at bringing managers in. It can be over 2 meetings if it ends up being a little bit too much. But we'd bring managers in, interview those managers, and then based off the interviews and comfort level with how they build the portfolio, then debrief, and then make a selection during that debrief. So same as what we did before. So with that, let me just pause, because I'm the next segue will be into infrastructure. So
Yeah.
Do we need a motion, Mr. Chair, to move forward with these three, or what is he asking for?
We're not moving, we have no action items on this
Okay, so
agenda.
this is just.
This is just information only.
Okay.
okay, so we'll touch base offline about the candidates that we want to take a look at, and getting time on the calendar.
Like we did before.
Like we did before.
Yeah.
Okay, perfect. All right, perfect. And here are a few other things that will be worth taking a look at. Inbound queues and outbound queues, liquidity in the portfolios. These are all things that we'll want to discuss. And then fees are not negotiable for this type of strategy, so that's the other thing to mention here. The sticker price is the sticker price, just given the nature of the asset class. Okay, so this now takes us to infrastructure. So infrastructure, another diversifier in the portfolio. You know, this is also through an RFP, and we do see here, again, pretty, you know, large entities responding to the RFP response. In terms of the tier 1 candidates, we're looking at Brookfield, IFM, JP Morgan, Macquarie, and Stonepeak. You'll definitely see that some of the managers being profiled, you know, large global entities. Goes back to the origin of infrastructure. This is an asset class that really, you know, gained momentum outside of the U.S. Just because of a lot of privatization, and then other pension funds outside of the U.S. looking to essentially monetize some of the big assets that they had on their balance sheets. When we think about infrastructure, again, these are your essential goods and, well, your essential services that can also help provide essential goods. You know, your IFMs, your JP Morgans, these are going to be your largest strategies. They were the first, you know, dominant players within the U.S. in this space. And then we've had other firms like Brookfield, Stonepeak, and Macquarie also gained pretty significant momentum, you know, in the U.S. The big difference between IFM, JP Morgan, and the other firms I just mentioned is the structuring around the portfolio. So JP Morgan and IFM, these are open-end strategies. Brookfield, Macquarie, and Stonepeak, these are closed-end in nature. In terms of geographic exposure, you are going to see, again, exposures outside of the U.S. This is a global asset class. So from a diversification standpoint, we do like the fact that you're globally diversified in essential economic goods, essentially. And then as we think about the, you know, the fee structures are going to be, you know, not as expensive as, let's say, private equity, not as cheap as the real estate we went through. Is going to be somewhere in the middle, where you essentially have a management fee, and then there is somewhat of a performance fee associated with the asset class as well. But here we can, again, being respectful of everyone's time, we can bring in all the managers listed here under tier 1, since this is the first time we're going through this. No issues on this end if we were doing that. So, you know, please let me know, and we can also just, you know, follow the same procedure we went through on the private equity side of things, if that sounds good for everyone.
What's the amount for this?
So it's 10% of the portfolio, so 17 million-ish.
So they all look the same to me. Like New York City. I'm trying to sort of see. Okay,
That's just headquarters.
they're all old and they're all same folks.
Yeah,
I'm not saying that's a bad thing. I'm just,
No,
but you're
absolutely.
asking me to pick between them. I'm like, it's sort of like they're identical twins. They're all the same to me.
Yeah, you're gonna see there is a bit of a, well, it's infrastructure, so there is a monopoly on not only infrastructure as a hard asset, but there's going to be a monopoly on the types of firms that can come in and underwrite these infrastructure projects. So
That being said, how do you differentiate? Like if it's a limited group of people that can do it, a limited group of people that even have access to it, all their target nets are sitting between 6 and 12%. Their cash yield are sitting right around 5%.
Yep.
They're all beige pants.
yes, they are.
Like I'm
So they're all allocated a little bit different across the various sectors. So you can see here, for example, you know, some are more geared towards energy and water. You're going to see some a lot more exposure to airports, some a lot more exposure to toll roads. So those are going to be the key differentiators. So in terms of how they invest, there's not going to be that much of a difference because these are infrastructure assets. Again, these are mega, huge assets that only a handful of entities are kind of structured to manage. But then how they express those viewpoints will be different according to the portfolio management style. So again, in hearing from the managers, the thesis around wireless and communications may be more compelling than, let's say, the one of airports, right? Airports, you can think of, they call them brownfield investments. So in infrastructure, you have greenfield, you have brownfield, and I apologize if I'm under explaining because this is a utility. But with your brownfield, that's your mature utility that's doesn't need a huge cash injection. It's just running. It's very steady. You're getting your income, from those tolls and those usage fees. From your greenfield, those are relatively newer. So these are either new plants or technologies being developed, and you're looking at less of a appreciation over the short term, but over the long term, there's probably going to be a big pop in terms of that new technology or that new plant and the revenue streams coming to it. So I think the big difference we'll see from the managers is around the maturity of the portfolio. And the maturity of the portfolio in a long-term investment horizon, if you think about a journey where it's like pretty smooth, pretty low returns, and let's say you get to 5%, and then there's another one where it's like pretty bumpy, but then you get to 5% through like a home run, it gives you a sense of just how these portfolios are structured to kind of get to where they need to. I would say that when we compare and contrast the managers, IFM and JP Morgan are going to be the most similar because they're the biggest and most mature. And then I would say Brookfield, that's going to be a little bit ahead of, let's say a Stonepeak. Stonepeak is still building out their portfolio. You're looking at 2 investments versus 9 for Brookfield. But, those questions and those conversations will kind of flesh out the key differences between the managers we're looking at. But at the end of the day, they're all operating in the infrastructure space, so there are going to be similarities in terms of how they look at the world.
Let me ask a question.
Yes.
Were these the only respondents, or were there more, and you and staff vetted and came up with these 5 recommendations? And as a matter of record, we do have another meeting scheduled for 10:30, so I want to try to wrap this up.
Sure. So these were the responses. So at the bottom of this page, you're going to see who else responded. You'll definitely see, some big, well-known names. But at the end of the day, when research went through the list and they were picking the tier 1 candidates, they went with the names that we just took a look at, these 5 names here.
If you don't mind, can you explain what is tier 1?
Yeah, tier 1. So basically, this is when we have an RFP go out, you can get dozens of responses. So it's for our purposes with clients, it's easier to say of all the candidates we reviewed, this is the short list. So tier 1 is the short list candidate list.
There's no thresholds for being in the tier 1.
Well, so there are thresholds. Some are subjective, but most of them are quantitative. So it's size of team, performance, track record, ability to raise funds, institutional quality, all of those things, reference checks, those things lend themselves to.
Look at the historical data on these.
Yes. Yes. So this is in trying to make everyone's life easy, this is just an abridged version of what we go through when the responses do come in.
I mean, they're pretty good, except for the Brookfield, they don't invest in other portfolio, except go back to the bar chart. Yeah, right there. You can see they are mostly in utilities, no roads, no airports, no ports.
Yeah, that's correct. That could potentially change just because they're building out the portfolio. So IFM and JP Morgan, you'll see that they have 21 holdings. You know, your Stone Peaks, your Brookfields, these are smaller funds. So they could, you know, over time, we could see a little bit more diversification.
Yeah.
So when they say 2 investments worth $4 billion, it's what? 1 port and 1 data center? I mean, what is that? How does that translate?
Yeah, so it would translate to 2 humongous investments in the portfolio that are mega size. It just points to, again, an infrastructure asset and how big that can be. I don't have, you know, off the top of my head, I don't have what those particular holdings are, but yeah, you are correct. Those are accurate ticket sizes when we think about what can be inside a portfolio.
And we could ask them, right?
Yes.
They
Definitely.
heavily invested in only 2 regions.
So I have a question, and forgive me if this is widely known and I'm playing a little catch up. Is this our best exposure to oil and gas sector directly, or is it through our?
Really good. That's a really good question. So I would say, let me take a huge step back. So firstly, why would a fund invest in oil and gas? It's typically because you're looking at an asset class or a segment of the market that does well against inflation, right? Your real return is going to be higher when you think about oil and gas. So some investors, they've invested in commodities, some have invested in MLPs. Those are so volatile that infrastructure would be not a direct play, but it would be a beneficiary of the oil
This
and
is our
gas
best
space.
exposure.
Yes.
No? With this allocation,
Yes.
this is our best exposure.
And you're not worrying about
Don't do yes or no answers.
It's like,
So let me check the time really quickly. So yes, okay.
I just want to be okay.
So here, no issue whatsoever if we you know, again, repeat the process we went through before with the managers on this list.
Okay. And we can be in touch with you again as before to set up those meeting
Yes.
timelines.
Yeah,
So-
absolutely, absolutely.
Okay. Are there any other questions from committee members relative to this?
So the only other thing to bring up on this end would be the RFPs. I don't know procedurally what steps we go through there, but we do have RFPs on the public market side of things now. So we've got.
we can meet with you after this meeting regarding that.
Okay, perfect. Thank you.
Thank you.
Okay. Thank you, Kriko,
All right, thank you.
again.
Okay.
There's one information item for the committee to review. Do we have any public comment?
No public comment, Chair, and we are ready for adjournment.
All right, so moved. Second? All in favor? Aye.
Aye.
Meeting's adjourned. Thank you.
Thank you.
Thank you.